Greetings everyone and welcome to our simplified stock investment course. So in this lesson we are going to look at bonds. So what is bond investment? So the first thing to know is that a bond is a loan instrument that is used by government and large companies to raise capital. A bond is a, going by the textbook definition, fixed income financial instrument used by governments and corporations to raise capital. So there are two. First, before we dive into the types of bonds, you have to know that there are treasury bonds and there are treasury bills. A bond is a long-term financial instrument. For example, if you loan money to the government for 20, 30, 50 years, that's a bond. But if you loan money to the government for a year or 6 months, 90 days, that's a treasury bill. Then there are two types of bonds. There are government bonds and there are corporate bonds. A government can raise money through bonds. A corporation can also raise money through bonds. Then bond investment terms. I'm going to use an example to better clarify this. For example, the government wants to raise 100 million. So the government goes ahead and say we want to have a bond of 100 million. Then the bond will mature in 30 years. The bond will mature in 30 years. Then what else? They say we are going to pay an interest of 10%. So if you are to hold the bond, you lend the government 100 million, then they pay you an interest of 10%. So it means the government will give you 10 million every year, which will be paid every 6 months. So every 6 months you are given a coupon, something known as a coupon of 5 million. Every 6 months you are given 5 million. Every 6 months you are given 5 million. So we've already, then the rate, the 10% we've discussed, is known as the coupon rate. Then at the end of the 30 years the government will give you the 100 million back. So that's known as the face value or the par value. Then maturity date is the date on which the bond will mature. Let's say, for example, you are given the bond, you issued the bond to the government, you lend money to the government exactly 30 years ago, and the bond matures today. So today will be the maturity date. Then at the end of the today, the government will give you the money, the 100 million that you lend to it. In addition to that, they'll give you the coupon, the 5 million above it. So let's just go through the terms quickly. The face value or the par value, it is the price that the issuer pays when the bond matures. If you get a bond that is written, for example, it has a par value of 50,000, at the end of the bond, when the bond expires, you are given the 50,000 in addition to the interest. Then the maturity date is the date when the bond ceases to exist, and the issuer of the bond must pay the principal to the holder. Then the coupons are the interest paid on the principal. For example, you lend money to the government and you come to an agreement that every 6 months the government gives you 50,000. After every 6 months, 50,000. So that 50,000 is known as coupons. Those are coupons. Then the coupon rate is the rate at which they are using to calculate the coupons you are given. Then bond prices vary depending on interest. When the interest goes up, the bond prices go down. It's a bit complex, but we'll discuss it in later classes. When to invest in bonds. The most people prefer investing you need to compare between stocks and bonds. Which one is giving better value for money at the moment? If stocks are underperforming, you invest in bonds. If bonds are underperforming, you invest in stocks. So you can use them together like that. Then you can use them when you need to diversify. Let's say, for example, both stocks and bonds are doing well, but you want to diversify, so you invest in stocks. Then last but not least, it is recommended for older people. Stocks are very risky, so if you want to reduce the risk, you invest in bonds. In fact, it is recommended that, for example, when you are in your 20s and your 30s, a large percentage of your investment is in stocks and, let's say, real estate. But as you get older, you reduce the amount that you've invested in stocks, then you invest most of it in treasury bonds. Advantages of bonds: they have low risk as compared to most other investments such as stock investment. Then they offer consistent returns. When you buy a bond, and let's say on the bond it's written that you'll be given coupons of worth 50,000 at the end of 6 months. Every 6 months, regardless of whether the economy is bad or good, you are given the 50,000. So consistent returns, as compared to stocks, which can give you a very high dividend this year. Next year the company performs poorly and you are not given anything. Then high liquidity. Stocks, bonds have very high liquidity. For example, if you hold stocks and you want to sell them, it's very easy. You go to the stock market, you put in an order, you sell them in most cases a day or so, and your bond is sold. But for example, if you buy land somewhere and you want to sell the land, it might take you 3 to 4 months to find the right buyer. And maybe, for example, after the 3 months, you find a buyer who offers you a very low price. So you decide not to sell, so it has very low liquidity. But bonds and stocks have very high liquidity. Disadvantages: affected by inflation. If you are to lend money to the government, for example, you lend them 100,000 now and they are to return it after 30 years. With 100,000 now, maybe you can buy a piece of land, but if they give you the money in 30 years, you cannot buy the land. So they are affected by inflation. The prices of things are going up, but the money that you'll be given is the same. Then low returns. When you compare bond investment with stocks, in most cases bonds offer low returns. They offer low returns, but the chance of you losing your money is less. So less risk, less return. Thank you for watching. See you in the next video. Remember to subscribe and turn on the notification channel to see more of our videos. Thank you.